Because we also have Rajesh Baheti on the same topic. He is, of course, Managing Director at Crosseas Capital Services. Rajesh, good morning. Good to have you with us here. You know, some of what has been, what's being reported in terms of what SEBI panel is likely to recommend is stuff that I think you were very much in line with as well, right? Which is increasing the F&O lot size. That's the most obvious, gets the most play. But there are other things. One expiry per exchange per week. And a few other things. Just your thoughts on what you've seen so far being reported as suggestions, Rajesh.
So yeah, first let's put some things in perspective. When we report that we are doing 80% of the world's market turnover, I think let's put that in perspective first. For example, if you take the lot size of the E-mini S&P, which is the E-mini S&P, that's about 2 crore 33 lakhs today versus 5 lakhs is the lot size in India. And therefore, if I do 5 lots and the S&P does 1 lot and I report that I'm doing 80% of the volumes in the market, I think that is a wrong way to look at the markets. So you've also got to look at the lot sizes and the total turnover by way of premium rather than reporting a number of lots traded as market share. So first thing, let's get things in perspective. Secondly, I think SEBI has clearly spelled out a problem statement that they have a problem with the lowest rung of retail entering this market and trading and getting attracted to trading, maybe getting addicted to trading. So two things. One is that I think today there are many other ways to get addicted. If you look at the scores of websites offering gaming on cricket, on poker. So maybe a study needs to be done as to how many UCCs are active in the F&O segment versus how many people are trading or speculating or playing those kind of gaming stocks and are part of that. So I think a little bit of perspective there would also help. The second thing is, if you want to attack the lowest rung of retail, you've got data on the number of UCCs that are trading the market today. If you want to get rid of, say, 20% of these, I think the best way to do it is increase the lot size, and that's a global pattern also, that the lot sizes in derivatives are higher than the lot sizes in the underlying market. So increase the lot sizes, and B, maybe set a financial liquid net worth criteria to be able to do F&O. And if somebody below that criteria were to do that, maybe specify an exam or qualification to be passed, because if you have the knowledge, I don't think finance should be restricting you. But what we're discussing today is so many variables that we want to play around with. I think that is where I fear that we are heading into a territory which could have unintended consequences. We know what has happened with the currency derivatives market. It took 15 to 20 years to build a market and one guideline to finish it. So instead of attacking many variables at the same time, I think just putting a little bit of a filter for retail, I think for the time being can do the job. You can always take data after you've done this.
Right.
And
Rajesh, no, got it. But I think what is being proposed is, I think, in line with what you were saying, increase lot size, right? That's one. Restrict weekly options, to one expiry per week per exchange. And limit the number of strike prices for options, upfront collection of options premium, something I think you've also advocated for, intraday monitoring of position limits. So these are all, I think not really out of the realm of what you yourself have been advocating, right?
No, not at all. If you restrict, let's say, option expiries to one per exchange, now I tell you what is the problem. The NSE has two very active contracts, which is the Nifty and the Bank Nifty. The BSE has one fledgling upcoming contract by way of the Sensex. Now, NSE has a market share of 80-90% in this market even today, and the BSE is 20%. Now, if you tell the exchange that you can only do one per contract, one expiry per week, you are actually giving BSE a chance to become 50% of the market, and by not by a very fair means, because you're telling NSE that you have to choose between the Nifty and the Bank Nifty, which are actually today the two most liquid contracts in the market. You choose one of them, and that then leaves the door open for BSE to come in. On the other hand, if you restrict weekly contracts totally, then I think the BSE would stand no chance at all to get any sort of market share. So I think these kind of measures are not advisable in my
Rajesh,
opinion.
but why would you put NSE at a disadvantage? I mean, if say for example all contracts expire on a Thursday for the NSE, everything on Friday for the BSE, right?
No, so the way is that capital gets rotated. Now, if I have 100 rupees of margin, I can only choose the $100 to be spent or utilized for certain contracts. And we all know, and this is a global phenomenon, that the shorter expiries attract more volumes and more intraday and special, HFT volumes. And if you were to restrict an exchange to one contract per week, then you're going to get a situation where the contract that is not the weekly expiry will completely die down. So I think, asking NSE to choose between Nifty and Bank Nifty would not be fair to NSE.
But surely this is better than withdrawal of weekly contracts, right, Rajesh? Because that was one fear.
If your problem is with the lowest rung of retail entering the market, why are we finding solutions that might have unintended consequences, like, destroying a segment of the market or destroying a product? We know how easy things can get destroyed. We've seen that happen in the recent past. I think if the problem is the retail, the solution lies in just putting some entry barriers to the lowest rung of retail. I don't think SEBI has a problem if a rich guy comes there and loses some money.
Yeah. No, got that. So the weekly options to 1 day, one day per exchange per week. I mean, that's essentially. But some of the other things that I mentioned, anything you have? Is there a pushback to any of the other measures?
Yeah. So in 2019, we moved from a very unscientific way of margining to an extremely scientific way of margining. And in return for that, we went to 6 sigma from 3.5 sigma, which makes us today the most margined market in the world and the safest F&O market in the world. And to fiddle with margins, I think would be counterproductive, because you're going away from science. I think something that are derived statistically should not be used as administrative tools to control markets. I think I'm completely against use of margining as a tool to manage volumes in the market, because all you're going to do is distort the science behind the application of margins, which is to contain risk, and be not allowing exchanges to freely launch contracts, because I think if you're allowing exchanges to list themselves, they are competitive and for-profit entities, and they owe it to their shareholders to find ways and means to increase shareholder wealth. So I think those kind of controls I would not be in favor of.
Okay, got that. Rajesh, sort of short conversation today, but we'll have you back because, these are suggestions. These are likely recommendations by the expert panel. We don't know how many of these will go through, but what you're saying is raise the entry barrier, larger lot sizes, and that should take care of the problem. If the problem, as the regulator sees, is retail, very small retail investors come into the market, and of course, maybe sort of mandate an exam, etc., to test knowledge when you enter the futures and options segment. Thank you very much for joining us. Good chat as always.